This tutorial is on leverage in derivatives markets. So, in perpetual futures within crypto, you can use leverage. Depending on the exchange, you can use anywhere up to 125x leverage on a centralized exchange. Now, if you take one thing away from this lesson, it is that leverage is not a way of multiplying your money. So you saw in a previous lesson how the very tutorial walkthrough video for this exchange, for Bybit, talks about how leverage is a great way to increase your gains, great way to get more upside exposure. And while that is technically true, it is very underhanded and it is very disingenuous by the exchanges. They would never push a product that wasn't profitable. So you have to ask yourself, if leverage is being pushed by all the exchanges, which it is, and exchanges only push profitable products, then where is the profit coming from? It's certainly not going into your pocket, or else you'd be a multi-millionaire or billionaire exchange owner. So the people on the other side of the trade of high leverage retail traders are the ones who make the money. And the ones who are on the other side of your trade, if you're a high leverage retail trader, are typically connected to the exchange as a market maker or some other large entity. So we've established that leverage is not a way of multiplying your gains. So what is it for? Well, the purpose of leverage is to reduce counterparty risk and allow you to trade position sizes much larger than the balance you have on the exchange, so that you don't need to hold as much money on the exchange to be able to still trade the size of position you want. Simple example, you have $10,000 in a MetaMask wallet, 10,000 USDT, let's say, and you know that exchanges can get hacked, they can go down, they can have all sorts of issues. So you don't want to put your $10,000 on the exchange to trade. So you put $1,000 on the exchange and you leave $9,000 in your wallet. You then add 10x leverage to the account and you are able to then trade a $10,000 position size, simulating the fact that you had, as if the fact that you had the full amount in your wallet. This will mean that if anything catastrophic goes wrong with the exchange, you lose only your $1,000, your 9,000 remaining dollars remain safe. But there are drawbacks to this as well. If you put your 10,000 on the exchange and you bought Bitcoin, you could not get liquidated because you have 10,000 of real money that you swapped for Bitcoin. So it doesn't matter what happens in a quick down move, your position will be unaffected apart from going down in notional value. But if you did the other method and put the $1,000 on, your position will be at risk of liquidation. So you can actually, if you're using Bybit, and we don't recommend any specific exchange for derivatives, there are a number of good ones. Binance is good. You can use Bybit, you can use BitMEX. There are a number of different ones. The best, the thing we would say and recommend most is that you shouldn't put any more than you need to on any one exchange. No matter how good or bad an exchange is, it is still a centralized exchange and anything can happen. So on Bybit, you can actually calculate this. This is one of the nice features. So there's a calculator in the corner and you can calculate profit and loss, target price, but you can calculate liquidation price. You can calculate entry prices. But if you look at a liquidation price, let's say on an isolated margin, long, 10x, and you entered Bitcoin at, let's say, 20,000, and you bought half of Bitcoin. We're saying we're simulating having a 10K position size. So, if you had 10x leverage, which would mean you had $1,000 and you times it by 10 because you bought half a Bitcoin at 20K. half a Bitcoin at 20k is 10,000 position size, which is how you reach this calculation. If the price drops to 18,100, you would be liquidated. So that is the drawback of using too much leverage on an exchange. So we would say never to go beyond 3x, even if you're going for capital efficiency, even if you're wanting to reduce your risk. Because as you can see here, the same 3x or the same leverage, same position size and quantity, but with 3x leverage, your liquidation price lowers down to 13,433, and from 20k to go all the way to 13,4 is very unlikely to happen in a matter of minutes. So if you did see price dropping and you wanted to add more collateral, you wanted to transfer more in from your MetaMask, you would be able to do so in time, most likely. So that's kind of a brief overview of the principle behind leverage, and then we'll see how it actually works in reality. There's two forms of leverage, cross and isolated margins. So in cross margin, it simply means that all assets you hold in the specific account, so in your derivatives account on this exchange, which you can see down in the corner, all the different assets in the derivatives account are totaled up and used as margin. So if you have USDT and you have USDC and you have Bitcoin and you have Ethereum, you have a sum of each, they will all be used to meet your maintenance margins, to prevent liquidation, and they can all be lost in the event of liquidation. Okay? So always be aware, if you use cross margin, your entire account is at risk. If you use isolated margin, as the name would suggest, it is isolated to a preset level of margin. Okay? So you would have it already set at a fixed amount. So if you have $1,000 in your account and you put it on 5x leverage, then it will only trade on a long. It will only trade with up to 5,000 position size. And the initial margin you applied, called the initial margin, would be all that would be used. So no funds from other wallets, no other funds in that wallet can be used. So it's always best to use isolated margin if you really want to manage your risk properly. So let's say that we have it at 10 and 10, and confirm it. You can now see on the order form that you have isolated margin with 10 maximum leverage on long, 10 maximum leverage on short. And then as per the previous video, you can open, close, set take profits, set stop losses as normal. The only thing that will change based upon your leverage use is your liquidation point, and it will affect the way you're able to trade. So, to clarify, leverage is not to be used to make more money. It's to be used so that you don't have to keep so much money on the exchange. Leverage can allow you to enter positions with a predefined size of risk, and you can use a stop loss in order to manage your risk. So for example, let's say in a trading example, I always recommend to use no more than 2% of your trading balance on each trade. So don't risk more than 2% of your trading balance on each trade. So let's imagine we do a long. And let's imagine that we have $1,000 here, but that your portfolio total is $20,000. So you have $20,000 in your trading portfolio on MetaMask. You put 1,000 onto Bybit because you don't want to put more than you need to on the exchange. But you want to risk 2% of your portfolio on a trade, which would be $400. Okay? 20,000 total portfolio size, you need to risk $400, 2%. And so you would use leverage to achieve that. So let's keep it very simple. If your order price was 16,000, so you want to go long at 16,000, and you want to risk no more than $400, you would have to find where your stop loss would be and then alter your position size in accordance with that. So for example, if you keep it simple, if you went to 15,600, and you had a 1 BTC position size, 1 Bitcoin, that's the take profit, sorry, 15.6 is your risk. Let's say that your take profit would be 16.8. On Bybit, it shows you nice and clearly that if you entered at 16,000, you bought 1 Bitcoin, and your stop loss was at 15,600, your expected loss would be 400 USDT. Okay? You can see the cost up here. Using 10x leverage, the cost would be 1618 for a long. Your account has less than 1,000 in it. So in that instance, 10x leverage is not enough to cover it. Reason being, to buy 1 Bitcoin at 16K is obviously 16,000. You have 1,000 in the account with 10x leverage, so you don't have 16,000 notional to trade with. So you need to alter the leverage. Put it up to 20. You have 20 now. You can now see that the cost of your long is 818, and you have 1,000. So you are able to put that position on. But you need to also account for the fact that your liquidation price might be within range. So what you do there is get your calculator again, get your liquidation price. Remember that it's isolated. It's 20x. Your quantity is 1. Your entry price is 16. Very simple. You can see that your liquidation price will be 15,280. Your stop loss is 15.6, so that is fine. It'll hit your stop loss before your liquidation price. You can enter this trade using the correct amount of leverage. Because you are not risking more than 2% of your portfolio, you are not taking an outsized risk. You are being capital efficient. You are reducing your counterparty risk. And you are putting yourself in a position where you can see upside with minimum downside risk in terms of exchange errors or issues or problems. So that alone is the correct use of leverage in derivatives markets.